So thanks everybody. So chapter 13 will be on corporations, organization, stock transactions, and dividends. This is all related to the equity portion of the balance sheet. And um, once again, this is much more, the hard part of this chapter is the content and learning about all these different transactions that I never really learned about until my first accounting class here at Anoka Ramsey, because I took it with Nancy. And so there's a lot of really cool stuff, and that all really impacts the price of the stock on a particular day when these things happen. So we're going to learn about characteristics of what stock is, how companies incorporate, why they decide to incorporate in certain places legally, and then stock splits, stock dividends, issuing more shares, buying back shares, paying out dividends. These are all things that impact the day-to-day movements of stock prices and the equity portion of the balance sheet quite significantly, because they impact how much assets does the company have and how many shares are outstanding. And we'll start with and just one other note, the homework is quite light this week, only 3 problems, but I will still be posting a video or 2 explaining, because in class today, I want to go over the concepts and what these transactions are. And then the homework videos will go in further depth onto how to actually do the journal entries. And we're going to go over the journal entries today, don't worry. But I just wanted to put that out there. And most large businesses are organized as corporations. For tax purposes, this is known as a C Corp. There's also S Corps, which are pass-through entities. C Corps, for tax purposes, are their own entity, and they are separate from the owners of the businesses. They're very easy to buy and sell shares. They're very easy to scale up to have millions of shares, millions of stockholders, and they're very large. Most small businesses are organized as proprietorships, partnerships, or limited liability companies. Proprietorships are pass-through. Partnerships are pass-through, which means the business's income shows up on the owner's personal tax return. Limited liability companies can be taxed as either pass-through or separate. And a separate entity means that the organization has its own tax return, it pays its own taxes, and then only the dividends are taxable to the shareholder. And more than 90% of total business dollars are generated by corporations, because that's big business. Most big businesses are incorporated as corporations because it's the simplest and simplest way to organize it for a public company. There are some public companies that are limited partnerships, but that's fairly rare, and generally only with certain oil companies is the only thing I've seen it as. And a corporation is a legal entity, is separate from the individual that owns, who created and operated it. It first started the Dutch East India Company from the Netherlands. When they were colonizing the world, they created a joint stock corporations where people could invest in a company, share funds, and then they're each entitled to their share based on the ownership portion in the company. That's their share of the profits, and those profits get distributed as what's called dividends. And the key part is that many people can share their finances and purchase stock in the company. The shares are easily traded, which means that they're liquid. It means people can get their investment back if they need the money. They don't have to wait for the business to sell as a whole. That's a huge advantage. And then it also, that gives corporations the ability to raise large amounts of capital, and it can enter into contracts and liabilities on its own. The shareholders don't have to be involved whatsoever in running the business. I could buy CSX stock, and I don't have to know anything about running a railroad. And the company does it all, and the financial loss that a stockholder may suffer is limited to the amount invested. That's very important. There is a liability limitation involved. So if a corporation gets involved in a huge environmental disaster or oil spill or other sort of catastrophic event, and they go bankrupt, the shareholders are not liable for the oil spill. They can't so that's really important. I mean, thinking about like private businesses, common example is if think about if we started a painting business and went to people's houses and had employees and someone's painting and they fall off a ladder and they crack their neck and they're permanently disabled and there's $1 million liability. If it's a corporation and the corporation is properly and legally funded, there's a limited liability concept. So the business owners, the shareholders don't go bankrupt because someone broke their neck and died on the job. And whether they should or not is for a philosophy class, but whether they will or not is a legal limited liability issue. And that's one of the main advantages of corporations. If it was a sole proprietorship, the business owner would be liable because the corporation is not a separate entity. A sole proprietorship, if it's not registered as a corporation with some sort of limited liability protection, the liabilities of the business are incurred by the shareholder or the sole proprietor or the partners of the business. And this creates some hierarchy and bureaucracy that's necessary to control the business. The stockholders are at the top, then the board of directors, then the officers, such as the CEO, and then the employees of the business. And there was a question when we were talking about internal controls. It's if the CEO screws up, who holds him accountable, or him or her, or whoever the CEO is? It would be the board of directors, and the shareholders hold the board of directors accountable. If we remember Elon Musk's pay package vote a couple weeks ago, that was voted on by the shareholders and approved by the board of directors, and then the CEO would collect the pay package. And so the advantages of a corporation is a separate legal entity. It can last forever. It can raise a large amount of capital. Ownership is easily transferable, so that provides a lot of liquidity to investors. And there's a limited liability, so the liability of the business is not the same as the shareholders. But then there's some key disadvantages, and one is that the owner is separate from management. So it can be, there needs to be trust there, that the that the board of directors and the CEO actually have the interest of the shareholders at heart, and they're not just paying themselves big salaries and not doing anything for the business. They're not going to run it into the ground. Bad management can totally run a business into the ground, and it's important that we know that they're doing a good job. And then there's also regulatory costs and double taxation of dividends. So once again, a corporation is a separate entity for tax purposes, so they get taxed at the corporate tax rate. And then dividends are taxed at the individual shareholders' dividend tax rate. And so then there's two layers of taxes compared to if it was a pass-through entity, it would only be the shareholders' personal tax rates. And there's a lot of complicated games that we can play with this, of course, because it's taxes and there's a lot of complexity there. But that is a disadvantage of corporations, is that the separate taxation means that the corporations are taxed. The rates right now is 21%, and then it goes on the individual's return for the dividends. Forming a corporation, it has to be registered with the state. So if you go to the Secretary of State of the state of Minnesota organizes all voting and polling. They also organize all registration of corporations. So if you guys want to start your own personal corporation for like as in a C corporation or a limited liability company, you just fill out some paperwork with the state, pick a name, and congratulations, you have a corporation. And you have to make bylaws and articles of incorporation, and it says these are the rules, this is who owns the company, this is how shares can be bought or sold, and there's all sorts of stuff that you can go to with Gallup and Legal Environment of Business. But There's also different state laws as to what are the rules around the corporation because they're all registered with the state, and most companies register in Delaware um, because Delaware has such a long history of incorporations, especially for large public companies, that all of the legal chicanery that can be involved in corporate disputes, disputes between the shareholders and the board and the CEOs and all the shareholders between each other, that's already has 200 years of case law. And it's an extremely efficient court. And so if there is a lawsuit, it will go to the court of Delaware and they will get you a verdict almost immediately. And it's very predictable and all the case law has already been sorted out. And so that makes it way less costly for lawsuits way less likely. Everybody knows the rules of the game. So as you can, most of these companies, big public companies that we all know, are incorporated in Delaware, although there are some exceptions based on essentially history. I mean, 3M is a Minnesota company in St. Paul or Woodbury, but it's incorporated in Delaware. And the costs of starting a corporation are expensed as organizational expenses in the current period. And so and this includes legal fees, taxes, and state incorporation fees because, of course, the state charges a fee, especially Delaware has a decent amount of fees to register in Delaware. And then we'd also have to hire a lawyer in Delaware and pick out a PO box in Delaware to be the address of the business. And then we would just expense that all in the current period to organizational expenses and then a credit to cash. And which of the following is the first step in creating a corporation? Well, I don't know. That doesn't make a lot of sense. I think it all is kind of done together. The paid-in capital, so that after incorporating as a bit, I mean, the first step is filing all the paperwork and getting all of that sorted out. Then comes the investment. And the main source of paid-in capital is from issuing stock. And so stocks have a number of characteristics. So there's the number of shares authorized, so there's the number of shares authorized, then the number of shares issued, and then the number of shares outstanding. So the first step in issuing stock is the board of directors has to vote to authorize, or the article of incorporation has to authorize the issuance of a certain number of shares of stock. Then the company goes and sells the stock on the public market. And then that would be, once the stock is issued for the first time, it would be both issued and outstanding. And the outstanding shares are shares that are owned by someone other than the company itself. And so then if a company does share buybacks, those shares would have been issued technically, but they are no longer outstanding because they have been bought back by the company. And corporations may issue stock certificates. However, most of the time now, this is all done electronically. And printed on the stock certificate, name of the company, name of the shareholder, number of shares owned. Private companies basically have a record, or they keep a record with a company that records these are all the shareholders, this is how much they own, and then they know who to pay the dividends to. And for public companies, it's all done by a clearinghouse that keeps track of who owns what, which was really important when we get into dividends and the dividend dates and who's entitled to what. And so once again, the board authorizes the shares, the company issues the shares, and then can rebuy back the shares later. And then so we have authorized, issued, and outstanding. And the difference between issued and outstanding is the share buybacks. And each share of stock has what's called a par value. And stocks can also be issued without par value. But the par value is sort of par value or stated value is a legal amount that a company says this is what the shares are worth at the beginning, but usually it's very small. It's called legal capital. And in the past, it's a really outdated rule, but companies still do it. And it was from early in sort of the New York stock market, mid 1800s probably, when they wanted to have a minimum amount that shares could be sold for. So if a par value was $5, then they could not issue shares for less than $5, and that was to protect existing shareholders. They wanted to make sure that no new shareholders were added at a super small valuation, and then that would dilute their shares. If you've ever watched The Men Who Built America, I highly recommend the show. It was a History Channel show, and basically Vanderbilt, a guy who was involved in starting the railroads, was trying to buy out another railroad, and he kept buying up all the shares that were available on the New York Stock Exchange, which at the time was just people yelling at each other on the floor, trying to buy up shares. And then they kept issuing more shares as he was trying to buy them up, and he didn't know. And then he never was able to acquire the whole company, and then he had to go to them later and pay a whole bunch more money. So they set up this whole legal capital concept. Nowadays, there's other regulations that make this very outdated. Most companies have a par value of a cent or less, and so then what that creates is a difference between the par value and the value of the stock like the price that the company actually issues the stock for. So for example, if Apple has a par value of 1 cent for their stock and they're issuing shares at 100, there's that $99.99 difference there. And that goes what's called additional paid-in capital, and we'll talk about that later. But common stock shareholders have the right to vote in meetings, the right to share in the distribution of earnings, and the right to share in assets in the liquidation of the company. So that's the main 3 advantages of common stock. So they get everything that's left over, all the profits of the business, and then preferred stock is sort of a hybrid between debt and equity. And preferred stock there can be multiple classes of shares. They can have different voting rights. They can have different values for example, Berkshire Hathaway, Class A share is worth I don't know how much exactly, but something like 100,000 B shares. It's like a crazy difference between the A shares and the B shares. So there can be that kind of difference, but those are both common stock share classes. Preferred stock has different characteristics. So preferred stock is entitled to get the dividends first. That's the preference for them. They're also entitled to the leftovers in liquidation. In liquidation of the company, it goes debt, then preferred, then common shareholders. But the upside of preferred stock is also limited. So preferred stock, for example, 8% at $50 par, they're entitled to an 8% dividend on $50 every year. And beyond that, they're not entitled to any additional upside shares of the business. For example, if it's a tech startup and they just blow up into this huge company, they would still only receive their 8% dividend on the $50 stock, but they would get that before anybody else got their money. So that's sort of it's like a hybrid between debt and equity. And so when there's money available for dividends, the preferred shareholders get the distributions first. And that makes it a little bit more secure, a little bit more predictable, but there's less upside to the preferred shareholders. And there's different types of preferred stock. Cumulative preferred stock has a right to receive regular dividends that were not paid in prior years. So for example, an 8% preferred stock on $50, if the company did not have enough money to pay any dividends at all in the first 2 years, an 8% of 50 is $4. So they're entitled to $4 per share per year. If the dividends are owed in arrears because they got behind on the dividends, the cumulative preferred stock would have to be paid the $4 dividend from the first year, the $4 dividend from the second year, and the $4 dividend in the third year for the common stock shareholders to be able to get any dividends in the third year. It has to be paid. They have to pay it back in the past, but they also don't owe it every year. So it's nice for the company. They have flexibility in when they have to make these dividend payments. So it's like both debt and equity. That's the way to think about preferred stock. But it is in the equity portion of the balance sheet, and it is a stock. It is an equity. It is traded. Um, yeah. Sometimes if it's non-cumulative preferred stock, if they miss a dividend, it's not owed in the next year. And so we can go over an example of what are the dividends that are available to the common shareholders. And so if we have total dividends paid in year three of $22,000, and then we have to pay our dividends in arrears, and there's $4 stock, $50 par for cumulative preferred stock. It can be expressed as a percentage, or there can be a stated dividend amount. It can be either way. So $4 stock means that they are entitled to $4 per year, $50 par, and 1,000 shares of that, and then 4,000 shares of common stock, $15 par. And so we take the 1,000 shares times $4 every year, and we get $12,000 of the current year dividends and then the dividends in arrears. And then we take the total amount authorized for dividends, subtract the preferred stock dividends, and the common shareholders are left with $10,000 in dividends, which will be divided by 4,000 shares. Then each share will get their portion. And so it's really important for investors to understand how this works. And this is all sort of disclosed in the financial statements of the company, the whole structure of how this is all set up. And so when you're investing in a company and you see a whole bunch of preferred dividends and preferred stock on the balance sheet, and it's a significant amount, it can really impact the return on investment for the common shareholders because these preferred dividends have to be paid first before the common shareholders can get any distributions. And so it can make investing in the common stock much more complicated because it's not only that the company has to be profitable, they have to be more profitable than $4,000 a year for you to get anything. So if you look on YouTube, Warren Buffett has some thoughts on preferred stock and different share classes and how complicated it can be. Um, and if you guys have any questions, please stop me at any point. So for issuing stock, we create a separate account for the preferred stock and the common stock. And note that we're issuing each of these at par. And so we don't need to record any additional paid-in capital. So we debit to cash and then credit preferred stock and credit common stock, which are both stockholders' equity accounts. And commonly, stock is sold at a premium or a discount, but most commonly a premium to its par value, especially now that no par and very low par value stocks are very common. And what this creates is, and then yeah, once again, large public companies use a financial institution known as a transfer agent or a registrar, most commonly the Bank of New York, because they're old and they have this all set up. And they keep track of who owns what shares and all the clearing houses and things. And like when shares are sold, how does the ownership transfer? And when a stock is issued at a premium, cash is debited for the total amount received, and then we credit the preferred or common stock account for the par value, and we credit paid-in capital or additional paid-in capital, and then we specify preferred stock or common stock. So for this example, we issued shares at 110,000, and then the preferred stock par is 100,000, and the additional paid-in capital is 10,000, or paid-in capital in excess of par preferred stock. And so which is also an equity account. And when stock is issued for assets other than cash, we use the fair value of the buildings or of the equipment or of whatever was contributed as the value that was received. So as our debit, we have to debit, if this was not cash, we would debit buildings at the fair value, and then that's how we compute our additional paid-in capital amount. And if we don't have a fair value, then we use the market price of the stock as the fair value. For example, issuing stock to pay for land, and this is more common than you would think. Lots of companies, especially smaller companies or companies starting out, will issue stock in exchange for supplies from vendors, in exchange for payroll services, or maybe the owners of a business just have a bunch of land and want to contribute it to the business in exchange for more shares. And so this is quite common to contribute assets other than cash to a business in exchange for shares. And so in this example, we debit land for 120,000 because we don't know the market value of the land. And so we assume that the market value of the land is a fair price for the shares, and the shares are currently trading at $12 per share, and they got 10,000 shares. So we estimate the value of the land at 12 times 10,000, and we get $120,000 as our land valuation. And then we credit common stock for the par value of 100,000, and then paid-in capital in excess of par for common stock, $20,000. And then no par stock is quite common, and we always just debit common stock for the proceeds. So if it's no par stock, then we just use whatever was received for the stock, and it does not matter whether the stock price has changed at different issuances. So if the first issuance is at $40 per share, we just debit cash for 400,000, credit common stock for 400,000, and then if it's $36 a share, we credit for 36,000, and then the debit and credit is 36,000. So no par is simple. We just use common stock. And sometimes no par stock has a stated value per share, and the stated value is recorded like a par value. So for example, if the stated value is $25 and we sell the shares for $40, then we have to split the cash received of 400,000 between 250,000 in stated value, which is to the common stock amount, and then paid-in capital of $150,000 to for the amount in excess of the stated value. And they do this because the par value is an outdated legal term, and they just don't want to have to deal with that if the stock price drops to less than what they would if they stated the par value at $5, and then the par value is less. And then if the par value is $5 and the share price drops below $5, in some states they might have some legal issues issuing more shares, and they don't want to deal with those problems at any point in the future. And so what they do is they just issue it no par and assign a stated value for show, basically. But then we record that for accounting purposes as a credit to common stock and paid-in capital in excess of the stated value. And which of the following is not a major right of companies that major right that accompanies ownership of a share of stock? Exactly. The right to hire corporate executives is the board of directors' job. And that's one of the disadvantages of investing in public companies and stocks is as opposed to small businesses, is that one single share doesn't have a lot of say in what goes on in the business. Um, we'll go over the solution to this, but I do want to make sure we get to a lot of the other stuff. Um, so the radiology, this radiology company has 2% stock, $50 par, which would be $1 per share dividend every year. And it is cumulative preferred, so they're going to owe dividends in arrears if they miss it. And we have this schedule of all the dividends um, paid over the different years. And so in the first year, and we have up on the top, we have our preferred dividends, and the bottom, we have our common stock dividends. And in the first year, we have $60,000 in total dividends declared by the board. And all of that is taken up by the preferred stock holders because there's 80,000 shares, each entitled to $1 per share per year. And so if there's $60, then it gets divided between them. And so each preferred shareholder gets 75 cents. In the following year, we have to make up that $20,000 or 75 cents, or $20,000 or 25 cents per share. We have to make that up in arrears. And so if we declare 110,000 in the following year, then 100,000 gets taken by the preferred shareholders, and then 10,000 is left for 200,000 common stockholders, so 5 cents per share for the common stockholders. And then in the following year, we declare $100,000, and then now only the $80,000 or $1 per share gets taken by the preferred shareholders, and then the remaining gets divided between all the common shareholders. And so on average for in the first year, the preferreds get 75 cents, and then they get the 25 cents to make up for the missing 25 cents in the first year. And then continuously forever, they are entitled to 25, entitled to 2% on their $50 in perpetuity. And really the preferred shares, the only way that they get really called back is they can be purchased back by the company on the open market if they don't want to have these obligations anymore, or there can be call provisions similar to bond call provisions. There can be preferred stock call provisions in the registration statements of them that say we have the right to repurchase these at certain points in time, for example, for $60 per share. So it's all in the terms and conditions. And we're going to skip this example. And once again, we can issue stock for assets other than cash. So in that case, we would debit land and then credit common stock and paid in capital for the par value and the amount over par. And that which brings us to dividends. And the board of directors declares cash dividends and stock dividends. And in both cases, declaring a dividend reduces the retained earnings of the corporation. And they do this because sometimes certain states or for certain tax reasons, retained earnings, the amount of retained earnings of the business is relevant. And so they choose to do a stock dividend compared to a stock split for different reasons, depending on what they want to happen to retained earnings. So that's the business justification behind stock dividend or stock split. And we'll talk about stock splits and dividends in a little bit. But first, we're going to talk about cash dividends, um, which is paying cash to shareholders. Um, and they have to have sufficient retained earnings, sufficient cash, and formal action by the board of directors. That's oftentimes businesses will have rules, especially by banks, that say you can't declare dividends out of paid in capital. It has to come out of retained earnings. And that's because they don't want people to invest in a business, take out a whole bunch of loans, pay a whole bunch of dividends to the shareholders, and then due to the limited liability nature of corporations, then the corporation is now underfunded and can't survive because all the cash got paid to the shareholders, and the debtors cannot come after the shareholders because they're separate. And so then there's no money left for the bondholders. So there's some regulations involved with when can dividends be paid, and is the corporation sufficiently funded? Um, yeah, I mean, think of private equity companies that will buy up a company, load it up with debt, and then pay out a whole bunch of dividends. That's a business model, right? And there's, depending on if the debt has been co-signed by the investors or not, the investors may or may not even be liable for then the debts of the business, even though the debt was taken out by the business, paid out as a dividend, and then the business is left with the debt. So that's the legal reason behind some of these little terms and conditions, but that's not super relevant to the accounting journal entries that we're going to be doing, right? And that's why a lot of the stuff in this chapter, it's more content heavy. The journal entries are quite simple, but I'm just trying to make sure that all of you have a good understanding of business law in relation to incorporating companies, dividends, investing, what investors are entitled to, because there's a lot of terms and things that can be going on here. And there's 3 dates. And as we were looking at before class, CSX Rail's dividend history, there's a number of dates involved with declaring a dividend. There's the dividend declaration date, and that is the date that the board officially authorizes the payment of the dividend. And at that point, the dividend becomes a liability of the company to the shareholders. The date of record, also known as the ex-dividend date, is the date the corporation uses to determine which stockholders will receive the dividend. And so if before trading hours, the shareholders own that share of stock, then they are entitled to the dividend. And the date of payment is a later date when the dividend is actually paid. And if any of you if you ever invest in a high dividend paying stock, and you'll notice that the stock will go up and up and up and up gradually, and then it'll go down every date that a dividend is recorded. And it always goes down on the date of record or the ex-dividend. It goes down on the ex-dividend date. Most of the time, that's the same as the record date. And for example, CSX, if they're paying $1 dividend on the record, and the date that you're entitled to the dividend is on the date of record date, on the date of record, the share price will drop $1. Because if you bought it after that date or on the date of record, you're not going to get the dividend. You have to own it like before trading hours on the date of record to get the dividend for the stock. And so these are all different dates just because of the slow process of how this has to happen. The board has to declare the dividend, and sometimes the date of declaration and the date of record is the same. For example, I did a lot of really weird fractional shares investing of like $10, buying like $10 of CSX Rail or like $2 of fractional shares in Fiat Chrysler automobiles when I was in school because I just wanted to invest in stocks. And when Fiat Chrysler sold off a portion of their business, they declared and recorded a dividend to be paid on a later date of a significant dividend, like a 20% dividend, but it was all paid in a single date because they had sold a portion of the business off. They needed to pay that. So the date of declaration and the date of record can be the same, but generally it's not. Generally, they declare the dividend, then they record it, and then they pay it. And so there's journal entries at different points in time of this. And so, for example, on October 1st, the following cash dividends are declared. And so a dividend per share of $2.50 for the preferred and 30 cents for the common stock, and total dividends of 42,500 was declared. And when we declare on the date of declaration, we have to record a journal entry debiting dividends and crediting dividends payable. And that's because when dividends are declared, the dividend payable becomes a liability of the business. And so we reduce our equity on the date of declaration. And then on the date of payment, we actually credit the cash and then debit the dividends payable. I don't know whether this would, I don't know why it would ever happen. I don't know why that would be common or not. But if a company declared a dividend and then went bankrupt, the dividends payable would be included as a liability in the bankruptcy proceedings. So when dividends are declared, that's official legal contract. The dividends are owed by the business. And so that's when we transfer. And again, this is actually wrong here. This cash dividends, this is in the equity section. So I don't know why this is an image from the textbook. I don't know why it's like, but cash dividends, would be our dividends or our payments in the equity portion. And then when we actually pay the dividends, that's when we would credit cash, because dividends come out of stockholders' equity. And then as part of the closing process, cash dividends, as part of the equity amounts, we transfer that in our closing entries to retained earnings. Also, there's stock dividends, which is distribution of shares of stock. Oh, another important thing to note, on the date of record, it's very important for the shareholders and the stock price, but there's no journal entry on the date of record because there's no change in assets or liabilities or stockholders' equity. So the date of record is irrelevant for journal entries. Only the date of declaration and the date of payment have a journal entry. And so stock dividends only affect stockholders' equity, and the amount of the stock dividend is transferred from retained earnings to paid in capital. And the amount transferred is the fair value or the market price of the shares that are issued. And so what a stock dividend does is, if there's a 20% stock dividend and someone owns 5 shares, they now own 1 more share of the business. So it just creates more shares. Or if there's a 100% stock dividend, if you own 1 share, you get another share as a dividend. And so it creates more shares of the business, and it transfers retained earnings to paid in capital for financial reasons of management based on whatever they want the retained earnings to be, usually for regulatory requirements. And this impacts the share price because more shares are on the market, but it doesn't actually impact the individual stockholder. It should not impact the value of the total shares that a stockholder owns, right? So if there's a 100% stock dividend and every shareholder's amount of stock that they own doubles the number of shares, the ownership percentage is the same. And the amount of the company that they all own is the same. So theoretically, the value of their 2 shares is the value of their 1 share that they had in the past. And so it doesn't impact but the share price on the stock market will drop in half because there's now double the amount of shares, but now everybody owns twice the amount of shares. And the journal entry, so we're assuming as follows. We're assuming that there's $20 par and 2 million shares issued, paid in capital of, so this is the initial account balances. We have 40 million in common stock, 9 million paid in capital, 26 million retained earnings, and we have a 5% stock dividend or 100,000 shares because there were 2 million shares initially. So we know that there's 100,000 shares going to be issued. So we take 2 million times 5%, we get 100,000 shares. And the stock price on the date of declaration is $31 per share. And so we take $31 times 100,000 shares, and that's the amount of stock dividends. And so 3.1 million in stock dividends, that reduces, well, that changes our equity. That's our temporary equity account for stock dividends that we need to close out at the end of the year to retained earnings. And then we have stock dividends distributable of 2 million and paid in capital in excess of par of 1.1 million as our credits, which are both equity accounts. And then when we distribute the stock dividends, we distribute on the date of payment or the date of distribution for dividends. We have stock dividends. We debit the stock dividends distributable and credit common stock because that's when the stock is actually created. And a stock dividend does not change the assets, liabilities, or total equity of a corporation. And it also does not change the individual shareholders' proportional ownership in the corporation. Assume a stockholder owns 1,000 of the 10,000 shares outstanding, and there's a 100% stock dividend, then now they would own 2,000 of the 20,000 shares outstanding. So their ownership percentage and theoretically the value of their shares is the same before and after a stock dividend. And yeah, the date of declaration is the date that the board formally authorizes the dividend. The record date or the ex-dividend date that's when you need to own the share to get the dividend, and then the payment date is when the dividend is paid. And there is no journal entry made on the record date. And note that a stock dividend is really similar to a stock split. For example, if there's a 2-for-1 stock split, that means that it is effectively a 2-for-1 stock split is the exact same as a stock dividend of 100%, but the accounting is different. There is no journal entry for a stock split. There is a journal entry for a stock dividend. And that's just because stock dividends are a way for management or finance team of the business to shift money from retained earnings to paid in capital for whatever of their own reasons, and also increase the amount of shares. And once again, a stock split, it reduces the par value of the common stock and it issues a proportionate number of additional shares. And it applies to all common shares, including the unissued and issued shares. And a major objective of a stock split is to reduce the market price per share of the stock. So NVIDIA went through a 10-to-1 stock split earlier in the last year and a half. And so if you owned 2 shares, you would now own 20 shares of NVIDIA stock. And that makes it more accessible for investors to invest in a single share of stock because if you don't have access to fractional trading, it's really hard to purchase a $2,000 share of stock. I mean, it's almost impossible, right? So, especially for me, like I'm not a zillionaire, right? So, and I don't think you guys are either. But you know, if you are, you should hire me as your accountant. Um, and so there's no journal entry for a stock split, but it does change the number of shares outstanding, and it also changes earnings per share. Um, for example, in a 5-to-1 stock split, everybody now owns 5 times the amount of stocks, but generally the par value is only 20% of the par value was before. Generally, the stock price is going to drop accordingly, but the total value of your shares is going to remain the same. And so the total par value before and after the split is the same. And so no journal entry is required. But before and after a stock dividend, um, depending on the accounting treatment, the par value could be different, but it shifts money from, or it shifts the accounting balance from retained earnings to paid in capital or common stock for a stock dividend. And so before the stock split, there's 4 shares of 100 par value. After, there's 20 shares of $20 par value. And dividends and stock splits. On the statement of equity, it impacts the statement of equity in different ways. So when a dividend is declared, it reduces retained earnings. And then when a stock dividend is declared, it reduces retained earnings, increases paid in capital and common stock. And stock splits have no impact. And when the dividend is paid, there's no impact on equity. It simply transfers from the dividend liability and cash. Right? It cancels each other out. And so the effect of a cash dividend and a stock split, no impact from net zero impact from a split or a stock dividend. Issuing stock certificates for the dividend, for the stock dividend, and then a cash dividend would impact, right? So declaring a stock dividend increases liabilities, reduces equity. Distributing it reduces assets and liabilities. Um, and so that brings us to Treasury stock transactions. And Treasury stock is what's created during a share buyback. So Treasury stock itself is the shares after they've been bought back by the company. And why do companies, so there's 2 ways to distribute capital from a company to the shareholders, and it's dividends and share buybacks. And oftentimes companies will buy back the shares instead of doing a dividend because of the favorable capital gains tax rates in the US. And capital gain rate for most people is 15%. It can be 0%, 15%, or 20%. Ordinary income can be up to 37%. And so if a company repurchases shares of the business, there will be less shares outstanding. The earnings per share will go up. And that means that the value of the stock per share will go up because it's higher ownership percentage, higher earnings per share. And then if somebody sells that stock and gets long-term capital gains tax rates, they're saving, if they're a billionaire, they're saving 17% on taxes because they're paying 20% instead of 37% on taxes. And so that's why companies do share buybacks instead of dividends a lot of the time. And so we're going to go over the journal entries to uh, buying back stock, reselling the stock, and bonuses and things like that. And so let's assume that there's a $25 stock and they've got some par values, some additional paid in capital, and then 650,000 in total equity for this stock. And then they repurchase 1,000 shares at $45 per share. And then they sell 60 shares of the treasury stock for $60. And then they sell the remaining for $40 per share. No dividends, cash or stock are paid on the shares of, oh, also important to note, the company owns these shares of stock. So they're issued stock, but it's not outstanding. It's not owned by the public or not the company. And so the cash, there's no dividends. The company doesn't pay dividends to itself. So we don't record dividends paid on the shares of treasury stock because it would result in a company earning dividend revenue from itself. It just doesn't make any sense. And so the journal entries for these transactions, we record the treasury stock on the balance sheet of we record it in the equity section as at cost. So when we purchase 1,000 shares at $45 a share, we debit $45,000, credit to cash of $45,000. And so we're reducing assets, reducing stockholders' equity because it acts in the same way as we're distributing money to our shareholders when we're doing a treasury stock, when we're purchasing back shares, we're distributing money to shareholders, which reduces equity and reduces our assets because same as a dividend, right? Dividends reduce cash, reduce equity. Treasury stock, share buybacks, reduce cash, reduce our equity. And so treasury stock is a contra equity account and recorded at cost. And when we resell the stock, we have to record the actual cash that's received. So we're reselling it at $45. We bought it back at 45, reselling for 60. And so there's a $15 gain per share there. But we don't record it as a gain because we're not in the business of making revenue, buying and selling our own shares to our shareholders. It's recorded as additional paid in capital from sale of treasury stock. So that $15 per share in gain, that gets recorded to additional paid in capital because that is investors contributing more money to the business. And if there was a loss, it would reduce paid in capital. And so when you're filling out these journal entries, the thing to remember is the cash is always going to be the actual amount of cash that's given or received in the transaction. And so I would always start with cash. And be very mindful of whether cash is increasing or decreasing in the scenario, and that determines whether it's a debit or a credit. And then that determines what the other part of the journal entry has to be. Initial share buyback of treasury stock, that's at cost. Reselling the treasury stock, the amount for the treasury stock port line in the journal entry, that's the initial cost of the treasury stock. That's the $45. So $45 times 600 or $45 times 400 for each of these journal entries. And the difference goes to paid in capital, which can be a debit or a credit to balance our journal entry. That's the important thing to remember. And, as with other sections of the balance sheet, there's reporting considerations for reporting stockholders' equity transactions, changes in retained earnings, and if you remember from the first 4 weeks of class, we had the statement of equity. This is just more details on the statement of equity. And there's two methods of reporting stockholders' equity. We can report each class of stock and each of the paid-in capital amounts. So we can say preferred stock and then additional paid-in capital for preferred stock. We can break it out, or we can show it as all the different types of stock and then additional paid-in capital separately. So we can break it out, or we can not break it out. And generally in method 2, we will disclose additional details in the footnotes if we're reporting the simplified version. Then we record retained earnings, and then at the bottom we record treasury stock. And note that treasury stock reduces equity in the business at cost that it was repurchased for. And oftentimes the most common method of reporting retained earnings is in a statement of stockholders' equity, but we can also show a separate retained earnings statement, a combined income and retained earnings statement that basically just shows the transfer of net income to retained earnings and then any share buybacks or dividends that impact retained earnings as well. For example, we show our starting retained earnings, our net income increases retained earnings, and then our dividends reduce retained earnings, and then we have our ending retained earnings at the bottom. And as I was talking about earlier, there are sometimes restrictions called appropriations on retained earnings. They can be legal, so that certain state laws, depending on the state of incorporation of the business, they may or may not allow them to distribute a certain amount of retained earnings. There can be contractual, which is most of the time would be a debt agreement. So a bank, as a condition of lending money, they cannot distribute a certain amount of retained earnings. They want to make sure that there's a cushion there for the bank's security. And then discretionary, the board of directors may restrict retained earnings voluntarily. They could just vote, we're going to restrict this amount of retained earnings. And then to reverse that restriction, they would have to vote again to reverse the restriction. And prior period adjustments, also known as mistakes or errors, result in a restatement of the prior year's financials and a prior period adjustment. This is different. We've gone over a lot of items that have been changes in estimates. For example, bad debt expense, depreciation expense, those are estimates. And if our bad debt expense estimate in the previous year was wrong, we would not do a prior period adjustment. But if we found a legitimate error in the financial statements in the previous years, we would have to restate the previous financial statements, and that would result in a prior period adjustment. But that would make sure that our current year income statement, current year earnings per share are the same. The balance sheet would change as a result of the prior period adjustment because we would restate the previous financials and then everything would roll forward from there. We would have all of our changes to our accounts would change as if we properly recorded a journal entry in the previous year. However, for changes in estimates, we don't do that because that would be chaos. I mean, we estimate so many things in accounting. We've gone over so many coupon estimates and bad debt expense estimates and depreciation estimates. Those are good faith estimates made, and if they're wrong, that does impact our current year balance sheet. But if they were an actual error, if they were made in bad faith or fraud, then that would result in a prior period adjustment. Then we have the statement of stockholders' equity. We've seen many of them in this course, and we have a beginning balance for all of our equity accounts, and then it shows the changes due to net income, dividends, issuance of more stock, and share buybacks. And then we have all of our ending balances and our total equity balance throughout, or the total equity and then the changes in equity. Um, for example, this is Alphabet's shareholders' equity statement. And the beginning balance for the statement of equity, common stock issued, repurchases of common stock, net income, and other being stock-based compensation expense. So that also would show up on the statement of equity. And I want to go over earnings per share. And earnings per share is, and this is earnings per share available to common shareholders. If you look at the balance sheet of a public company, you will see net income and then net income available to common shareholders. So we have to take net income, subtract preferred dividends, and divide by the average number of common shares outstanding during the period. And there, that seems fair, that on the face of it, earnings per share is very simple. Net income divided by the amount of shares. And there can be a lot of complexity involved in that. That's more of an intermediate two topic, such as how do stock dividends and stock splits and issuing shares during the period impact the weighted average earnings per share during the period. However, for this purposes, we're just going to use average number of shares, net income minus preferred dividends divided by average number of shares outstanding. And so we take our net income and then divide by the average number of shares, and we get our earnings per share of $13.99 for the recent year, prior year, $10.22. And this is one of the most important metrics that everybody that is using a company's financial statements, this is what investors care about, earnings per share. It is the most important metric on a company's financials and quarterly financial statements. These past couple weeks have been earnings weeks, and everybody's just been on edge as to how many they all have an estimate of how much per share a company's going to make, and are they going to beat the estimate or miss the estimate, and by how much, and then what's the guidance for the following years. Because earnings per share and the dividends, that's what actually drives investor returns in the long run. So that's what it, and taking a percentage of the earnings per share, a PE ratio is the share price divided by the earnings per share. And that shows basically a valuation metric for the business. It's if the business has a share price of a PE ratio of 10 would mean $10 per share and $1 in earnings per share per year. If you expect that to remain the same forever, you're expecting about a 10% return on the investment because the business is making a 10% earnings per share, which eventually it's not going to sit in retained earnings forever. Eventually, the shares will be bought back or the dividends will be paid, reducing retained earnings and increasing money for shareholders, basically. So I know we've gone over a lot of topics, and this is not stuff that I learned until I took accounting classes, and I have a feeling that I'm not alone in that. So if you have any questions, please let me know. I know we have 2 minutes left, and we can take questions, and I also have balance sheet up for company. So I guess does anyone have any questions on this? Because I know same as how a normal one's worked, or Well, so for stock splits, there are no journal entries for stock splits, reverse or not reverse stock splits. But a reverse stock split, if it was a 1-to-2 reverse stock split, or if you could say it as a 2-to-1 reverse stock split, if you had 2 shares, you now own 1 share, and the par value would double per share. The earnings per share would double per share. The stock price would probably double per share, but no journal entry for regular or reverse stock splits. And I don't think a reverse stock dividend would be possible. Um, so, this is the retained earnings here. And then right below net earnings, we have basic net earnings per share of common stock. And so that's that's the number that investors are looking at when they are looking at a balance sheet, basically. And in the equity section, we have issuance of shares, stock-based compensation expense, repurchasing shares, and net income. That's what goes into the equity. So, yeah, great job, everyone. Yeah, that's all for today.